Okay, so hello again to the new joiners. I think we're almost all here, so we can go ahead and start. So hello, I'm Nairi Tarakdjian, a Business Development and Marketing Associate at LuxFLAG, and I'm here with
Ahmed Ouamara, Head of Sustainability Operations at LuxFLAG.
So today we will guide you through what is LuxFLAG and the LuxFLAG Microfinance Label and its updates. So yeah, I will give a brief introduction about LuxFLAG for those of you that don't know us, and then my colleague Ahmed will dive into the microfinance label and the criteria and give you a few more details. If you have any questions, please feel free to put them in the chat box or the Q&A box actually, or if you prefer to voice your questions, we will open a Q&A session at the end and we can answer all of the questions you may have. Okay, so first of all, a bit about LuxFLAG. So what is it? So LuxFLAG stands for the Luxembourg Finance Labeling Agency. It was founded back in 2006, and it was founded as an independent and international nonprofit association. We were founded by 7 private and public founding members. Some of you may know them all or not any of them, so I will go through them for those of them that don't know them. We have ABBL, which is the Association of Banks and Bankers in Luxembourg, ADA, which is the Association for Support for Autonomous Development, ALFI, which is the Luxembourg Association of Investment Funds. Then we have our fourth, which is the European Investment Bank, Luxembourg Stock Exchange, Luxembourg Microfinance, and then the government of the Grand Duchy of Luxembourg, which is composed by 3 ministries. We have the Ministry of Environment, Climate and Biodiversity, the Ministry of Finance, and last but not least, the Ministry of Foreign and European Affairs. Then recently in 2023, we welcomed our last charter members, which is ACA, the Association of Insurance and Reinsurance Companies here in Luxembourg. So LuxFLAG was founded to foster sustainable finance both locally and internationally through our awarding our prestigious labels. So here we have our mission and values. So our main mission is to drive positive change in the international financial landscape. And how do we do that? We do it by awarding our trusted labels. So really our end goal is to enable informed investment decisions, driving positive social and environmental outcomes. And we enable all of this through transparency, responsibility, independence, and contribution. So now that you know a little bit about LuxFLAG, what is a LuxFLAG label? So we like to say that a LuxFLAG label is a tool for asset managers to demonstrate sustainability, ESG, and impact credentials of a said financial products. So we are recognized globally for our independence, rigor, and compliance with regulatory standards. As you can see from the slides, we have 2 categories of the labels. We have, first of all, our impact labels that were designed by our team for mission-driven products with positive social or environmental impact. And then we have our sustainability transition labels that were designed for products focusing on ESG best practices. Then it's also important to note that we have our AFS, which stands for Applicant Fund Status category, which is a category of label available for all pre-launch funds. So all of the funds that are in the fundraising period. And it's important to note that this category of label is applicable throughout all of our labels. So the impact labels and the sustainability transition labels. So now what makes LuxFLAG unique? And what makes us stand out. As you see here, we are very proud of many things here at LuxFLAG. So first of all, and very important to note that we have a very global scope, and we are able to label financial products in any jurisdiction. So that's quite a unique thing for a labeling agency. We are also asset class agnostic, which means there's a wide coverage across diverse asset types. We also have the reviews of the applications are done at a company level, which is quite unique. We have a very we have an expert team at the operations team that do all of the review of the applications, and Ahmed will explain that a bit later. And we are also renowned for our strong governance, which is supported by the ESI 3000 Type 2 certification. And lastly, we're also renowned on our expertise in impact investing and sustainable finance. So just a little bit about the benefits. So one of the benefits is enhanced credibility, as it allows to boost trust with rigorous ESG standards. It also allows for market differentiation, as it allows your product to stand out to investors in a now very crowded market. Another benefit, of course, is transparency and disclosure, as it brings clarity on ESG practices to make informed decisions for the end investor. There's also an aspect of risk mitigation because it aligns products with environmental and social risk management. And then, as we were saying before, the global usability is another added benefit because we said our label is applicable across many different jurisdictions. And then lastly, the long-term performance, as our label supports sustainable growth and value creation in the long run. So now, last but not least, we have the ESI 3000 certification, which I mentioned before. ESI stands for International Standard on Assurance Engagement, and it is a voluntary standard that deals with assurance engagements of non-financial information. So we were actually certified back in 2019 for the first time, and we were the first labeling agency to get certified by a third party. So we are very proud of that, and we've been certified ever since 2019. And so how does it work? It is basically a verification of internal procedures against a set of predefined criteria that is audited on an annual basis by an external independent auditor. And why do we do the certification, and why do we keep getting it every year? We believe it enhances transparency, competence, and integrity, which is part of our core values and mission. So as you can see here, we have a bit more of a visual version of our impact labels and our sustainability transition labels. So we have, first of all, the microfinance label, which was actually the first label that was launched and created by LuxFLAG. So now Ahmed will speak about that one. Then we have environment, climate finance, green bond. And then on the other side of the labels, sustainability transition, we have ESG for insurance products, and ESG for discretionary mandates. So thank you for listening to the first part, the introductory part. I will now pass on to Ahmed, which will give you a deeper dive into the microfinance label. Thank you.
Thank you, Nairi. Thank you very much to all that are present today for this webinar, where we're going to explain the changes that are going to affect the microfinance label. So in this slide here, you're going to find the three key aspects, the revision of the criteria of the microfinance label. The microfinance label is actually where the activity of LuxFLAG started. So back in 2006, this was the very first label started to operate. And to this day, it is still very much up and running. And with the evolution of the market practice in the microfinance and financial inclusion sector, LuxFLAG has actually put in motion an update of those criteria to reflect the market trend. So there are three main items that really would like you to take away from this discussion today or from this presentation today. Those are the first, transparency; second, to go global; and third, high quality standards. The objective of the label remains identical, and that is to make a difference with those products and with these investments. What do we mean with the transparency? So here, the previous situation in the criteria was to require that the applicants have exclusionary criteria. The update that we'd like to present today will require that those products have an exclusion list or policy in line with international standards or framework. So here, what we expect as a LuxFLAG is to have a minimum of coverage of controversial jurisdictions, controversial behaviors, and controversial weapons. The parties that the funds and the applicants are currently dealing with are also usually subject to a number of additional exclusions coming from international organizations. So here, really, what we expect the applicants is also to continue to follow those exclusions and also to disclose those exclusions and to refer to them. Really, the first point here that we want to make very clear is that enhancement in terms of transparency and making sure that those exclusions from a jurisdiction's behavior or activity dimension are actually documented and disclosed. So this is really the first key aspect of the update of the criteria that we are proposing to you. The second, and that's going to echo what Nairi mentioned and about what makes LuxFLAG unique. Until today, the criteria of microfinance label were referring to the SFDR Article 9 products only. With this update and considering the objective to go into jurisdictions that are not covered by SFDR, the criteria will become that funds which have a microfinance or inclusive finance strategy, that the funds have a microfinance or inclusive finance strategy that is in line with its sustainable investment objective. So meaning to say that the funds need to have indeed, in the very first place, a sustainable investment objective, one, and second, that is articulated around a microfinance or inclusive finance strategy. So this is indeed here the former SFDR Article 9 requiring a sustainable investment objective, going to something that is more international, still keeping in mind the objective of having a sustainable investment objective from a fund perspective, one, and two, that is articulated around this microfinance or inclusive finance strategy. So that's, as you can see, that's the second item here on this slide, to go global. So we said one, transparency, two, go global. And the third is the high quality standards. And that's really here about the asset allocation. So far, the criteria was requiring us to have at least 50% into microfinance related investments. This threshold has increased to 70%. So this is indeed increasing the level of the requirement with regards to the strategy and to the focus of the funds or the products that would be applying to the microfinance label. So there, indeed, what we want to mention as well with regards to those criteria update is that right now, of course, we are presenting those and they will be effective from the next batch of application. So meaning from Q1 2025. And those products that need a bit more time to reach those levels with regards to these three criteria, or at least to these key aspects, of course, there will be a transition period. And the transition period is going to be one label validity cycle. And that's really important to mention. So again, our role is also to help you get there and to discuss with you and to engage with you as to what could be the possible steps that may be taken to actually reach that level. So again, it's very important not only to mention that those changes are effective, but attached to it, there will be, and there is indeed, a transition period of one label validity cycle. So from a criteria perspective, if we want to look at the key elements again, and what we mean here, There you can see the full-fledged of the criteria of the microfinance label. And here you have a bit more detailed version. What we can mention as well here again is, for example, on the impact measurement, what you would notice is that here we mentioned that you must measure and report on social performance. And that's again part of the initial due diligence, where indeed the criteria remains identical. What we want to stress here is that the applicants, they need to conduct an initial and an ongoing due diligence here with a social performance dimension on the entire set of investments that they make. In parallel, or on the flip side, what is expected is that none of those investments will be exposed to any of the excluded either jurisdictions or behaviors or activities or sectors. So that's indeed here where we materialize this change. I will maybe pause for a couple of seconds to let that sink in. Here you can see again, the rest in substance remains perfectly identical. In particular, I want to highlight the microfinance/inclusive finance strategy in line with the sustainable investment objective. For those products that are subject to SFDR, it doesn't mean any change. However, for those that are in jurisdictions where SFDR does not apply, if you have a sustainable investment objective with a strategy that is indeed into microfinance or inclusive finance, then we can indeed consider you as an applicant. In addition to those change of criteria or this update of criteria, there is an important part also that we want to mention. I referred earlier to the changes that may take place within one label validity cycle. It's not only one good news. The second good news is that the validity cycle is also increased itself. So it means that not only what used to be 1 year validity cycle with a renewal on a yearly basis is going to be valid now going forward from Q1 as well for 3 years. So in the first year, as you can see here, you're going to be subject to a review of applications where the application will take place in a form of questionnaire. So the applicants are going to receive something is apparently not working with the connection. Okay, we're back. So I was saying that the application is going to take place with a validity cycle of 3 years, and that the first year application where the initial review is going to take place will take place in the shape of a questionnaire. So applicants will be submitted a questionnaire that we expect to be filled in so that we will engage discussions on the basis of the answers to those questionnaires. From a scope or perimeter of the review, this questionnaire will match the criteria and the current aspects that we're looking at in our reviews. So it's very important to mention. Then what will happen on year 2 and year 3 will be about the confirmation of the investment policy or the investment strategy that the fund is putting in place. And we will continue to review the portfolio with a specific review and with a specific review of the content of the fund, in the sense that we will do a sampling, a screening, and then a sampling of the portfolio. All these steps that are currently in place. So again, the extent of our review will remain around the 4 Ps, what we usually refer as to the 4 Ps, which is 1, the philosophy of the fund, 2, the process of the fund, 3, the people and the governance of the fund, and 4, the portfolio. So all these steps will continue to apply, maybe in a more prominent way, because this is something that applicants are going to be able to materialize through the questions that are part of this questionnaire. And the intermediary review will actually take the shape of a simplified approach where we're going to look at the changes taking place between the initial review and the intermediary review. So those are expected to take place, as you can see here, in year 2 and in year 3. So in addition to this implementation of a questionnaire, the fees of the application review are going to change as well. So the fees will be for the initial review 6,000 euro versus 3,000 today, and the intermediary reviews taking place in year 2 and in year 3 will continue at the same level as today, meaning 3,000 euros. So in total, over the 3 years of the validity period, the total expected cost of the label application review will be 12,000 euros, split as in 6, 3, 3, respectively in year 1, 2, and 3, versus right now a yearly review with a fee that is 3,000 per year. So again, from a questionnaire perspective, from a fee perspective, and from a criteria perspective, this is where you have updates. In parallel, what does not change is the content of the review that is articulated with the 4 Ps, and the governance, where you still have those steps where the applications are reviewed within the team, then where you have a first layer of review, we apply 4 I's principle, so we have a quality assurance. Then we have a CEO recommendation taking place. Then we have another layer which comes with the label eligibility committee. And ultimately, once the recommendation for the label application has gone through all these governance steps, the LuxFLAG board makes the decision for the applications. So this strict governance and process is actually the one that is building the credibility of LuxFLAG, and also this is precisely why we have this ISA 3000 that Nairi mentioned earlier. So that's for the changes that you can expect with regards to the microfinance label. Those will be applicable from Q1 2025. Now I think we are very much open to questions. Yes, Q&A session. So you can use either the Q&A function within within Teams or through the chat. Both will be checked.
Yes, Karina?
Yes, I hope it's okay that I place my question here vocally. I think it's might be easier. So I reviewed the new eligibility criteria, and I have some questions about it. The first one would be that, as you mentioned, now we have to have 70% of the total assets, including cash, in should be microfinance portfolio. And microfinance portfolio, you state in the definitions that it's doesn't take into consideration consumer loans. So I'm not sure how to work with that, because some of our microfinance institutions, of course, have their share of consumer loans. Sometimes that's really consumer loans, and then we usually state in the contract that we don't finance this part of their portfolio. Or sometimes could also be that they label it consumer loans, but there might be something different behind it. So how to deal with institutions that have a share of consumer loans?
I think it goes to the, we'll be looking also at the definition as to what do we consider those loans. Here I will refer to so there will be local norms, indeed, and within those local norms, we'll be looking at the ones where, depending on the methods, we're supposed to have, yes, where so the microloans here, we'll be looking at the average loan amount divided by the GNI per capita.
Mhm.
Which of course will be depending on the country, and where we would expect this amount to be lower or equal to 150%. So we're going to take this calculation, and we will sort of look at every single line of your portfolio and make sure that it works, or it is indeed in line, and recompute this 70%. Again, if we're not there, i.e., if we're between 50 and 70%, what we expect there is to engage with the different financial services providers. As I said, we have this transition period of 3 years, so this is really the occasion to get closer to these FSPs, and to see what are the options that are feasible, and also in terms of classification. I think you really pointed out one element also that we have also identified, that we're expecting, in terms of how are those numbers computed? How is the classification internally taking place with every single of these financial service providers? So right now, I would say back to our methodology and what we said in terms of transition or grandfathering period, where we want to make it work. First, by checking the numbers and see what are the actual numbers, and then see to which extent this 3-year transition period could be useful.
Mm-hmm. But like, if we have 70% or even more that apply to your definition with the GNI, there could still be some institutions that have a share of consumer loans. So if we can state that we take a look at it and we don't finance actively this part, then we would be fine according to your definitions.
From what I understand right now, yes.
Okay, so there will be portfolio items that will have a share of consumer loans. Yeah, okay. But then
because
I think,
again, we'll be looking at how big is the proportion of consumer loans at the FSP level.
mm-hmm.
How much of their activity does it represent? And if it's more or less than 50% of their activity, then
yeah, okay.
Then we would consider this particular FSP as not qualified as a microfinance investment.
Okay.
So first we look at the overall picture as to whether it does or does not represent more than or the majority of the activity of the financial service provider, and then we compute the numbers to see if it reaches or if it doesn't reach the 70% threshold. And if it doesn't, then we would engage and make use of the transition period. So you see, you have like 3 different steps.
Okay, thank you.
Welcome.
Yeah, Sarah, go ahead.
I'd like to continue in this kind of question. So you will continue to do the assessment at the financial service provider and not at the use of proceeds. So say if we were to finance a bank with the specific requirement to disperse small loans from our financing, we would still have to reflect on the bank's portfolio and not our specific share.
Correct.
Okay. Thank you.
That's correct. Yeah.
And another question on the pricing. Existing members, do we also have to go through this initial review, or will we jump right back into the intermediated review?
No, everybody will start with the initial review from Q1. So depending on your application quarter, if you're due for renewal, let's say in Q3 next year, then your initial review is going to take place at your next renewal, which will take place in Q3, right? So 2025, if you want, will be considered as the year of the entire initial review, so that we can indeed trigger this 3-year validity period. And then 26, 27 will be intermediary reviews, considering that 25 was the year of the initial reviews. So this is how it's going to work from a review perspective.
Okay. Thanks.
I see also the question from Mariella on the chat. Indeed, I confirm that the data from the World Bank is indeed accepted. So it's perfectly fine if you're using the World Bank website.
Okay, thank you for all of your questions. Maybe if we'll wait. Okay. Yeah,
Karina, is it a second question or?
Yeah. And maybe also a third.
Please.
So I have again one question about the definitions in the new criteria. So you mentioned that the MFIs or the service providers have to be a registered institution. So in the past, you were working with regulated and rated. So we had to report which institutions were regulated and which were rated. But registered is like just to see that's a registered company. Or is it still referring to be regulated or rated?
Excuse me, Karina, which page are you referring to?
It's in the criteria, it's the second page. And then there is a definition: microfinance institution / microfinance service providers is a registered institution.
Yes.
So it's just looking that it's like a registered company, but you're not looking for regulated or rated anymore.
Yes. Again, well, we'll continue to look at it.
Okay.
But that's not something that we sort of keep through the criteria. It's also something we have observed in terms of market practice. The funds we're dealing with, the products we're dealing with, to a very, very large extent, deal only with either rated or regulated institutions. We couldn't come across neither of those categories.
Okay, so we would still have to report that, but if it was below 70%, the share of, for example, regulated MFIs, it's not a problem.
Yeah.
Okay, that's good.
Yeah, because also there are managers that have their own that are not referring to external ratings, but they have their own internal ratings systems in place. So that's also to instead of making exceptions for those cases, I think we want also to hear the way you guys tackle these items when it comes to other rating, if you're using on a third-party source, if that's something that you are yourself generating or producing internally.
Okay. And maybe one question about the ongoing due diligence with the social performance dimension. So it's stated in the criteria that it should be performed on 100% of the investees, but there will always be some investees where we don't do it. For example, restructuring cases or institutions, maybe holdings that cannot provide the data that we require. So if we know it already, we wouldn't perform any social performance dimension. So not with the questionnaires or something like that. How would we deal with that? Because we wouldn't reach the 100% in that case.
For that, what is important for us to mention is that within the social dimension, we're also looking at client protection. So I think it's really the number one point in our expectation here. Really, what we want to understand, I would say it's more of a it's the rationale behind. If there's a structuring or any hurdle that's really blocking the way. But there again, I think we want to make sure that it's going to be a criteria, and the due diligence at some point you must have had an initial due diligence on those elements, and showing that from an ongoing term, if there's a restructuring, it doesn't happen overnight. That's something you must have followed, and that is going to indeed materialize the ongoing review or the ongoing dimension of your monitoring.
Okay, thank you. And maybe the last question. So, like the exemption from some taxes that we were granted with the label, that's probably the same, right? As still with the new criteria, there shouldn't be any changes.
Well, to my knowledge, the law has not changed. So that's it's two different things. That's in my view, the only thing I can, I mean, if you want to be sure, the only thing I can say that is to get in touch with your tax or fiscal advisor. But to my knowledge, there was no change in this exemption. But there again, it's maybe best to check with professional advice on tax or fiscal aspects.
Yeah. Okay. Thank you.
Okay, it seems like we have no more questions.
No.
So thank you to all for listening. Thank you, Ahmed, for the explanations. If you have any other questions that may pop up later in the day, you can email us at communications@luxflag.org. So yeah, please feel free to reach out, or if you want to schedule a call to discuss further, we'd be happy to do that. And wishing you all a nice afternoon, and we'll see you at the next webinar.
Thank you all.
Thank you all. Bye-bye.